Three Dividend stocks are on sale right now, one opportunity cheaper than the next. And while many investors, for whatever reason, just continue to flock to tech stocks at their all-time highs, I say feast on these three fast food dividend-paying juggernauts before the masses of investors return to the table and snatch your opportunity. With that said, are you ready? So first and foremost, all of today's opportunities lie within the one sector that has been pretty beaten down given the nature of our economic environment, which thanks to stubbornly high inflation has a lot of consumers pulling back on some of their habitual spending habits, or at the very least, just thinking twice about them. Now, if you want more macro insights to really come to understand our economic environment and how it's impacting you, be sure you're subscribed to the channel because I cover it all in much greater detail every single Sunday. But for the sake of today's video, I do want you to come to understand that businesses ranging from Home Depot to Walmart, McDonald's, Pizza Hut, heck, even Apple have all reported in their latest earnings reports weaker than expected same-store sales because of consumer trend shifts. Now that is key. This should not only have you perched up as an investor, but fired up because this investing game is all about buying stocks on sale when they are in fact in the red, like right now. Now, don't get me wrong, not all sectors are created equal. Say travel right now has actually been booming, and these companies in the travel industry have been celebrating strong and persistent spending by consumers, so these trend shifts are sector specific, and for good reason. And because consumers are in fact cutting back on dining out experiences, especially from fast food joints, where it seems the value menu is no longer a value menu, I just want to go ahead and ask you three questions. Number one, what are the chances that over the next 5 to 10 years, inflation is going to remain exactly where it is today? Question number two, should inflation actually come down, therefore alleviating cost burdens on fast food businesses, will value be restored to their menus? And finally, question number three, arguably the most important. Do you really think some of the most dominant names within the industry will just disappear after decades worth of top-notch branding that allowed them to scale into what they are today? I want you to keep all of those questions in mind as we run through these three dividend stock opportunities. And most importantly, following the end of the video here, be sure to let me know which one of these stocks you actually own or will be buying into, or if you totally disagree with everything I'm sharing in today's video, I want you to go ahead and comment those thoughts as well. They are all accepted. With that, up first, Restaurant Brands International, which is the operator of several fast food chains from Burger King to Popeyes and Tim Hortons, allowing for some padding of safety through segment diversification. I know that's what you're all probably looking for. But of course, Q4 results were mixed, and the biggest overhang on shares was the guidance which their team projected 4.5% net restaurant growth in 2024, which is a bit of a slowdown from the previous guidance to 5+%. However, we did see some positives like the international digital sales growing by 20% year over year, making up over half of the segment's system-wide sales. And in comparison to its peers in the industry like McDonald's, Burger King had much stronger growth. Nonetheless, we see the opportunity with Restaurant Brands International thanks to their share price right now sliding to $70 per share, which is almost 9% down on the year with a PE at 17.9. But long term here and zooming out, we see over 147% worth of appreciation. As for analysts, as of this video, they maintain a buy rating with 22% worth of upside expected, to which the share price would hit $85.50 per share. However, I would be in Restaurant Brands International for the dividend, which comes in at a yield of 3.31% that has been growing over the last 11 years, and get this, by 25% year over year. Next up, if Burger King made its appearance by way of Restaurant Brands International today, well, you better expect its biggest competitor, McDonald's, ticker symbol MCD, to have made the list. Now, McDonald's is a very interesting opportunity among all the mentions today because it's not just about grilling Big Macs and frying fries. McDonald's is really a real estate empire, which is often underappreciated. That is to say that McDonald's corporate buys a ton of properties and then leases those properties out to their franchisees, meaning they not only generate profits from your orders, but simply because, well, rent is due every single month from their franchisees. Now, McDonald's Q1 earnings marked its lowest quarterly same-store sales growth since COVID. Geopolitical issues are impacting McDonald's as well, all on top of just lower in-store traffic. On the flip side here, positive note, McDonald's opened up around 1,900 new restaurants just before 2024. Menu changes have been underway as of recently, recently, and investments in the restaurant automation are set to improve order flow, reducing errors and waste, and improving overall franchise unit economics. So as the share price hovers around $247 per share, down by over 15% on the year with a PE at 21.3, I'm in fact still loving it, especially as I zoom out to see over 219% worth of appreciation over the last decade. As for analysts right now, they foresee a $309 share price, which would make for over 24% worth of upside. And until then, we get a McDividend coming in at a 2.7% dividend yield. That's been growing on average by 15% year over year for the last 20 years, keeping true to its 47-year dividend track record. But if the king and, well, Ronald McDonald aren't quite the opportunities that you've been looking for, there is some real liquid dividend gold pouring out of Starbucks, ticker symbol SBUX, which is one of the world's most dominant coffee house chains, as I'm sure you know. They have over 32,000 stores in 80 countries worldwide. Now, I want your honesty here when it comes to Starbucks. I am personally not a fan of their Mocha Choca Grande Frappe lattes or really anything they offer, but let me know down in the comments if you are, and when the last time you were actually in a Starbucks was buying whatever you were buying. And if you're really feeling wild, I want you to go ahead and let me know what the order was and just how much it actually cost you. Stock-wise, have a look here at the recent nosedive from $87 per share down to $74 per share, ultimately down by 21% on the year, PE coming in at 20.9. But zooming out, this is really nothing that we haven't seen before during harder economic times, with Starbucks ultimately prevailing and appreciating by nearly 130% over the last decade. Now, as Starbucks is considered a luxury item for most of us, I am not surprised that we see the declines in sales that we're seeing today. Geopolitically speaking, we had very weak sales out of China, with competitive pressures really ramping up in that region. But on a very positive note, the latest comparable sales out of China rose by 46%, and Starbucks is making an entry into the energy drink market, which could gain share with Gen Z, a cohort that is increasingly interested in energy drinks, all prompting analysts to hold firm on their forecasted share price hitting $88.63 per share, which works out to 18.85% worth of upside. And as for that liquid dividend gold I spoke of, well, we have a 3.06% dividend yield coming in. However, I want you to note that Simply Safe Dividends just rated it as 60 in terms of their dividend safety. Nonetheless, it has been growing quite rapidly here by about 17% year over year over the last decade, and remains on a 13-year dividend streak, at least to date. Now, there you have them. Comment below with all of your thoughts on each of these dividend stocks. Let me know which ones are actually in your portfolio, which ones you're buying, and definitely let me know your latest Starbucks order. But before you go ahead and click away, I want you to click into this video here for more insights. Make sure you're subscribed to never miss a single video, and I'll see you in the next one.